Hey folks, it's Dr. Jeff Camarda, continuing with our thesis and economic and investment evaluation and forecast. This snippet is on the trade war and the investments impact. As we write this, the global trade situation is improving slightly. Deals are inked with South Korea, Mexico, and a contentious Canada, and talks with Japan and Europe look like they're hustling to the finish line. This leaves China as a 600,000-pound dragon in the room. Relations on all levels with China are at modern low points and really just getting kind of ugly from a number of different perspectives, and not just economic, and getting quite worse. Besides the tariffs game of chicken, China's been subverting North Korea and other sanctions, aggressively challenging our military's planes and ships, and allegedly implanting spy chips even on computer motherboards that it exports to us. While the relationship's complicated, for trade at least, we expect some normalization probably sometime next year. China needs our markets far more than we need it, and there's no doubt that the Trump Trade Doctrine has disrupted many investment plans after a very prosperous 2017. We think this has displaced, or better yet delayed, many of the gains Camarda expected for 2018, particularly in our substantial non-U.S. investments. In the end, however, we think the trade medicine was appropriate, necessary, and again, in the end, will prove wonderful for not only the U.S., but most of the rest of the world. The U.S. is by far the most important economy in the world, and many folks think it's about time it extended more of its considerable influence in its own behalf. I'm in that camp. This seems to be happening, and we think in the end it'll be very, very good for investors. Largely, we think because of this trade disruption, the difference in values for U.S. versus foreign stocks is at its biggest spread since 2009, right at the bottom after the 2008 meltdown. In other words, U.S. stocks are overpriced by many historical measures, even with the recent plunges we're seeing driven by bond phobia and interest rate increases. Even after the recent plunges we've seen in the U.S. markets, many foreign stocks are relatively much cheaper. U.S. stocks have become increasingly expensive compared with major indexes elsewhere. A recent Wall Street Journal piece said something many analysts worry could leave the U.S. markets vulnerable to a snapback heading into the final months of the year, and I think that's probably begun. Certainly risks of a U.S. market correction are high, and the drops that we've seen in early October may be just the beginning of a very bumpy period ahead. The market, priced for perfection in some ways, seems to have finally gotten the message that interest rates are really going up, and this will have significant economic impact. While this has been official Fed policy and obvious to many of us for years, it's finally sinking into stock and bond prices. Investors have been dumping bonds, driving prices lower and rates higher across the yield curve. Camarda's been warning about the risks of bond price cave-ins for over a year, so we won't get into that again now. But the important point is that the stock market seems to be getting interest rate religion, and that will impact prices as rising interest costs dampen profits, business, and the general economy. And that's far enough for now, I'm sure. Thanks so much for watching. Until next time, this is Dr. Jeff Camarda.